Welcome to the Techno Fundamental Report for September the 11th. I've said it before, and I'm going to say it again, because it cannot be overemphasized. The most important change in my trading career occurred when I learned to divorce my ego from the trade. Trading is a psychological game. Most people think they're playing against the market, but the market doesn't care. You're really playing against yourself. You have to stop trying to will things to happen in order to prove that you're right. Listen only to what the market is telling you now. Forget what you thought it was telling you 5 minutes ago. The sole objective of trading is not to prove you're right, but hear the cash register ring. Martin Schwartz, he was a famous investor. Doug Gregory, trade what's happening, not what you think is going to happen. So listen to the market. It's very efficient. Now, I wanted to mention something about the economy. A good friend sent me this graph. It's U.S. business applications. Roger Lowenstein wrote an op-ed in the Journal about American exceptionalism. He says last year, 1 out of every 24 households registered a new business application. You don't start a new business if you're worried about the future or hard work. So in other words, it's kind of having to do with sentiment. Everybody is very pessimistic about the economy, but in reality, people are starting businesses. I did want to point out, though, that the small caps have really been underperforming for quite a while. So my attitude would be tend to avoid the group for now. It could improve, but so far it's pretty much in a downtrend relative to the large cap growth stocks. Stick with those. Foreign stocks. Again, I've been hearing a lot about foreign stocks. Now, they have rallied, but they're definitely in a downtrend relative to U.S. stocks. I would stay in the good old USA. The VIX. This is an interesting study that says the S&P 500 after the VIX falls for 4 months in a row. Now remember, the VIX is a volatility index, and the lower it goes, the more optimistic or the better it is. So you can see here 1, 2, 3, 4, 5 months where the VIX has dropped. Now, according to this indicator, the average return 1 year later is 10.34% on the S&P 500, and 9 months later, 100% of the periods were positive. Don't buy breakouts. According to legendary trader Jesse Livermore, breakouts need to prove themselves. This means that when a stock breaks out of a trading range, a trader should not immediately assume it will continue in that direction. You wait for confirmation. He emphasized patience and waiting for confirmation from the market itself rather than acting on an opinion. So what I do, and the way I handle this is that if I get a breakout, I have to have the breakout prove itself. So take here with NVIDIA. The actual breakout came right about here when it broke above that 200-day moving average. So it then started to prove itself. It was a successful breakout. However, here's an example of a company called Confluent. You got the breakout above the 200-day, but it immediately fell. So how do you deal with this? Well, you have to look at your total position size. And so in my case, my total massive or major or maximum position size is 10% of the portfolio. So I'll start out with a test buy at 5%. Now, if the stock moves up at least 2%, it's starting to prove itself, and then I'll add to it. But I'm not going to add to it in this situation because it broke out, but then immediately failed. Now, here's another example of something I dealt with here recently. This is a company called Life 360. It broke out, and it broke out of that base in a major up move, but then it started to fail. So that's an example. Now, what Livermore is arguing here is that he thinks institutional investors manipulate stocks in order to create liquidity for them to get out of a position. So let's just say, T. Rowe Price has a big position in this stock. They want to lighten up. So what they do is they come in and buy a bunch of shares just to get a lot of us regular folk trying to buy the breakout, but then it immediately fails. So just be aware of this. Let's look at the market, see what's going on. NASDAQ continues in an uptrend, no problem. We're above both moving averages. Same thing for the S&P 500, very positive uptrend, above both moving averages. This is a bull market, and you better make hay while the sun shines because you're only going to get so many of those in your lifetime. Here's the primary trend, 200-day moving average. This is the S&P, very constructive. Here's the NASDAQ, very constructive. Again, this is a bull market. Now, the unemployment figures came out. We're back up to 4.3 on the unemployment rate, which to me would be probably an indication the Fed's getting awfully close to cutting interest rates. Here's the aggression index, continues to hit new highs. We're comparing the NASDAQ to the consumer staples, and this looks very positive, very good. Now, on interest rates, they continue to look down to me. They're in a downtrend. Our power index continues to be below zero, basically saying for the last 125 days, trading days, the 5-year Treasury note has a yield that has dropped by 12.18%. So the market's telling you that interest rates are probably going lower. New lows on the New York Stock Exchange, way under control. The sellers have dried up. This looks very positive. Now I wanted to show this fund here. This is the IPO fund called the Renaissance IPO. It's a index or a fund that invests in IPOs. And when the IPO market is healthy, that's a very positive indicator for the market and the economy. Here's Oracle. Oracle had quite a day today. It was up almost 36% on extremely high volume. Their revenues came in from their businesses this morning. It looks very positive. So if you have any questions, please let me know. Thank you very much.